Good day and welcome to the AFS Financial Solutions Executive Webcast. As a reminder, today's call will be recorded. At this time, I would like to turn the conference over to Mr. Jay Waldron, Executive Vice President of Sales and Marketing. Please go ahead, sir.
Well, thank you and welcome everyone to today's webcast. We have well over 1,000 registrants for this webcast, which indicates how much executives want to hear from our distinguished speaker today, Mr. John Barnes, a partner with Grant Thornton, about today's topic, critical update on revenue recognition under IFRS. Let me provide a quick overview of our agenda for today. I'll be spending a few minutes on AFS Financial Solutions and how we fit into today's topic, and then I'll turn the program over to John for the majority of our hour together. At the conclusion of John's prepared remarks, we've allocated time for him to answer questions submitted from our audience. To ask a question, please look at your webcast console now and find the Ask a Question feature located at the lower left-hand corner of the console. At any time during the presentation, feel free to ask a question. I'll be reading your questions during John's presentation and have them queued up for him when he's finished with his prepared remarks. The most commonly asked question is, can I get a copy of the slides? The answer is yes, but we make you work for about a minute. At the conclusion of the webcast, you'll see a pop-up window containing a survey page. Give us your feedback and tell us topics that interest you, and upon completion you'll receive a copy of today's slides as well as a link to an on-demand recording of the presentation that you can share with others. Before I turn it over to John, I'd like to provide a brief overview of our SOFTRAX products and how they benefit companies with complex revenue processes. As many of you know, SOFTRAX products were initially developed to serve the complex needs of software companies, and we are the clear leader in that market. Today, hundreds of companies across many different industries trust SOFTRAX products to optimize their billing and revenue processes and to ensure they comply with appropriate revenue recognition guidance and Sarbanes-Oxley requirements. We provide enterprise billing and revenue management solutions that optimize order-to-cash and order-to-revenue processes, from complex contracts, billing arrangements, and contract renewals through revenue recognition, reporting, and forecasting. Our mission is to help customers consistently grow their revenue and reduce their costs while remaining compliant with the ever-changing regulatory and accounting guidelines such as those John will be reviewing with us today. If you are manually managing your revenue recognition processes and spreadsheets or struggling with compliance, we would be happy to see how we could help. Studies have shown that managing the revenue process is one of the most difficult challenges companies face today. It's been identified as the most complex and challenging area to establish internal controls, and the high use of spreadsheets by companies to manage deferred revenue highlights the fact that enterprise financial and ERP applications are not designed to manage revenue. The graphs you see on your screen are taken from studies in this area that RevenueRecognition.com has done. For those of you who wish to learn more about these studies, they are available on the RevenueRecognition.com website, and you'll see the URL for that at the end of the presentation. The risks of managing revenue outside of an enterprise system are many. Certainly there's a great compliance and restatement risk, and the revenue numbers are always of high materiality. Many studies have found delays in closing processes due to complexities of business models and the volume of data that needs to be analyzed. And many companies, even large public companies, are relying on broad assumptions for their revenue forecasting. And if they're relying on manual processes, many companies struggle to consistently comply with ever-changing revenue accounting guidelines. Initially, this was principally limited to the software companies with the introduction of SOP 97-2. But since that time, there have been a number of new revenue guidelines that companies across many different industries have struggled to comply with. The latest example being EITF 081, which many companies are challenged with as we speak. Knowing that additional changes will be coming with our topic for today, IFRS, companies are looking for a more reliable way to ensure compliance with the appropriate guidance. What many companies are coming to recognize is that in order to ensure that they remain compliant as accounting standards change, as well as when they introduce new products and billing models or acquire a new business, they need to systematically manage order to revenue as a separate and distinct process from order to cash. Over the past 10 years, we've had the opportunity to work with hundreds of companies to systematically manage and optimize their order to revenue processes, from the initial execution of a contract through the complete revenue lifecycle. And based on this experience, there are 3 key areas we would recommend you focus on to ensure an effective and compliant order-to-revenue process. The first consideration in adopting best practices around the order-to-revenue process is to establish fair value for your products in the various markets in which they are sold. In doing this, you want to make sure that the way you establish and manage fair value is consistent with the way you go to market. You will want to consider the external parameters that affect the way you package and sell your products, such as geographic region, channel, or industry. To do this most effectively, you will need a centralized repository of revenue data containing all of your actual selling price information for the appropriate periods, with the ability to analyze and sort it by the relevant parameters that affect your pricing, such as geographic region, channel, or industry. The second best practice consideration is revenue allocation. Depending on the particular guidance you're following, you will need to identify all separate units of accounting for each arrangement, even if they are not separately billed for. You will then need to allocate revenue using the fair value you have established for these units of accounting. To do this most effectively, you need a repository of fair value prices for each unit of accounting we just discussed. You then need a process to consistently allocate revenue across all units of accounting in the arrangement using your fair value prices. Third, for each unit of accounting in the arrangement, you need to manage the revenue schedule and ensure all revenue recognition conditions have been met before releasing revenue for that unit. You will want to systematically track revenue allocations for each arrangement, as well as the revenue release conditions to support your audit and compliance requirements. And of course, you want to manage your order-to-revenue process without restricting your ability to evolve the way you price, package, and deliver your products and services to the market. And from a government risk and compliance standpoint, you want to ensure that all the data relevant to your order-to-revenue process is stored in a controlled, auditable system, including billing information, all the revenue allocations, and revenue recognition conditions. And you want to ensure you maintain the appropriate level of reporting and documentation to maintain your established fair value, as well as support your financial audit and compliance requirements. It's now my pleasure to introduce Mr. John Barnes from Grant Thornton. John is a partner in the Advisory Services Group in Grant Thornton's Mid-Atlantic practice. His experiences have included providing external audits and internal controls consulting within the CASO framework and coordinating such work with all of the Big Four accounting firms. John assists with the coordination of the firm's advisory services offering around IFRS and is the go-to guy with respect to IFRS, especially as it relates to process and technology. We clearly have the right person for this topic, and we're delighted to have you back with us again, John. The floor is yours.
Thank you very much for that very kind introduction, and thank you everyone for attending today. We literally could spend a few hours doing a webcast, but today really wanted to focus on giving everyone an update as to what is going on with IFRS as it relates to revenue recognition, give you some current events that have just occurred in the past couple weeks, some updates on what the FASB and the IASB are doing, talk about the similarities to US GAAP, talk about some major differences in the current status. So if we really look at the authoritative guidance as it relates to revenue and revenue recognition, there's about 3 major IFRS pieces, and that is IAS 18, IFRIC 13 and 15, and SIC-31. Now you can see the listing of US GAAP, which probably a lot of us are very familiar with, and the reams of paper that are involved with the current US GAAP revenue recognition policies. And the major difference, as everyone is probably aware on this call, is the US GAAP presents a much more rules-based approach to accounting, where IFRS is a very much more principles, broad-based accounting methodology. And we're going to get into some of that in the next slides. So we're going to go over an overview, scope, recognition, and measurement under IFRS. So under IFRS, revenue recognizes economic benefits as they come into the company, and during the ordinary course of activities, these inflows result in equity, other than increases relating to equity contributions. Seems very much in alignment with what we're used to under US GAAP. When you look at IFRS, you really think, okay, when do we recognize revenue? And you recognize it whenever you can measure it reliably, whenever there's a flow of economics benefits probable, and costs are measured reliably. Now, in IFRS, there is some guidance over goods, services, and others. In the course of this webcast today, due to our limited time, we're going to look at goods and services. We don't have time today to cover customer loyalty plans, bill and hold transactions, barter transactions, that sort of stuff. But there is guidance within IFRS on those types of transactions. So IAS 18 applies to the sale of goods, rendering of services, and interest, royalties, and dividends. However, it does not apply to lease income, dividends from equity method investments, insurance contracts, extraction of mineral ores, and the few others that you see on the slide there. So those are covered by other IFRS standards, and we've excluded them from our presentation today. So generally speaking, we recognize revenue whenever goods or services have been delivered to a customer. We separately identify components of a single transaction, and we link transactions when there are two or more together that commercially they could not be separated to separate transactions. Revenue and expenses that relate to the same transaction are recognized simultaneously, so that there is a matching of revenues and expenses. So whenever we have a sale of goods, we recognize revenue when there's been the significant risk and rewards have been transferred to the buyer. The seller retains neither a consulting managerial involvement or any type of ownership in the good. Amount could be measured reliably, and it's probable that the economic benefits associated with the transaction will flow to the seller. Now, when we get into the services end, it's somewhat similar, but it is, we look at, is it probable that the economic benefits will flow to the entity? Can the stage of completion be measured reliably? What are the costs incurred to complete the transaction? And when the outcome of the transaction involving the rendering of services cannot be reliably estimated, then revenue should only be recognized to the extent that expenses are recognized and recoverable. As I mentioned before, the difference about IFRS is there is not the specific criteria related to multiple elements transactions. However, in certain situations, it's definitely going to be up to the preparers of the financial statements to reflect the substance of the transaction. And that's really to the heart of IFRS. It is asking the preparers of the financial statements to provide a lot more of the thought process as to why items are being accounted for in certain ways. So let's go through an example of a multiple element transaction. So a manufacturer sells some product to a purchaser. Goods can't be sold without the standard warranty. At the same time they're purchasing the product, they can get an optional extended warranty. The extended warranty can only be purchased at the initial sale. It can't be purchased separately at a later date. In accordance with local consumer legislation, so the sale can only be analyzed in this way. There's a product supply, there's a standard 1-year warranty service, and there's an extended warranty services. So we can't separate the standard 1-year warranty service and the product, and they're combined for the purpose of revenue recognition under IAS 1819. So the entity recognizes revenue based on the fair value of the product in the standard warranty, making provision for the estimated cost of that warranty. Although they only sell the extended warranty together with the product sale, the customer can take the product without the extended warranty. So that component does have a standalone value, and what Entity M does is defers the recognition of the revenue for an extended warranty, recognizing it over the 2-year period during which the service would be provided, if necessary. There are restrictions on revenue recognition, and they result if the seller retains a significant risk of ownership because there's an obligation for unsatisfactory performance. The sale might be contingent on the buyer selling the goods. Goods are shipped subject to installation, or the buyer has the right to rescind. If there's only an insignificant risk of ownership, such as a retail sale where a refund is offered to the customer, revenue is recognized provided that the seller can reliably estimate future returns, and there's a liability recognized for those future returns based on previous experience and other factors. So making an estimate at the time of the sale is recognized. Measurement is similar under IFRS. Fair value of consideration received or receivable. However, if there is consideration receivable in the future, present value is used and interest income is recognized as the discount unwinds over the time it takes to realize that receivable. So really whenever we look at some similarities under IFRS, there is the definition of revenues. General recognition criteria. Revenue is not recognized until it is both earned and realized or realizable. Classification of revenues of gross versus net. So those items are not going to change whenever you're preparing your financial statements. However, there are very significant differences. Timing and amount of revenue can be very different based on the contracts. You really need to look at IFRS and get in there, read the statements, understand how it might apply to each of your individual businesses to understand how it will affect that revenue. And that is why we encourage companies at this juncture to spend a lot of time understanding how items are, how it could be impacted. To that point, recognition. Your separation of elements may occur earlier under IFRS. It could be earlier revenue recognition. That could be great, but that could also not be the intended consequences of the arrangement. It sounds great on the face of it, but that might not be what we all had set up for. Service revenue may be different in terms of how it's analyzed and disclosed in the statements. I talked a little bit about discounting, which we're all aware of the fair value push in the financial statement arena, and it is getting to that point where if you look at IFRS, and you have that future receivable, you're going to need to discount it at a rate, recognize the revenue at its net present value, and for the difference in that receivable, recognize it over time. Now, interestingly enough, the IASB and the FASB are working on a joint project on revenue recognition. There's a discussion paper that was issued in December 2008, and it's continuing to solicit comments. Also, the IASB and FASB are working on a joint project where an exposure draft is to be issued in the second quarter of this year, with a final draft by the second quarter of 2011. And under US GAAP, there was recently a EITF 08-1 that were issued, and EITF 09-3. Now, while the IASB and the FASB work towards convergence, there is not a exact determinate date where everything will be converged. It's an idea. It's a great idea to work towards convergence, but nobody's come out and said it will be converged by a certain period of time. Recently, there was an article in the Journal of Accountancy which talked to this, actually in the March 2010 issue, and it laid out about the items that were going to be covered under convergence over the next 12 to 15 months. And in December of 2009 at an AICPA conference, IASB board member Patrick Finnegan presented a six-step process to demonstrate how the proposed model might be applied under revenue recognition. And that would be to identify the contract, identify the performance obligations, determine the transaction price, allocate the transaction price, recognize revenue when performance obligations are satisfied, and then account for contract cost. There's still a lot of work to be done in this area, and additionally, there is some guidance that's recently come out on revenue recognition and disclosures. The disclosure requirements that are be required of companies were discussed at a recent meeting, and they'll require an entity to disclose the nature of contracts that it enters into customers, principal judgments used in accounting for contracts with customers, a reconciliation of the beginning and ending net contract position, the total amount of outstanding performance obligations and the expected timing of their satisfaction, information about onerous contracts, including the extent and amount of such contracts and the reason for them becoming onerous. The board's continuing to develop proposals for revenue disclosures. The boards will continue their discussion of disclosures and consider scope and transition issues at the forthcoming meetings. We wanted to allow ample time for questions to the extent we could. So with that, Jay, I'd be happy to answer any questions from the audience or any questions that you have yourself.
Excellent. Thanks, John. We have a number of questions that have come in, and please keep submitting your questions, and we'll get to as many of them as we can. First question, John, is will there be percentage of completion of accounting under the converged standards, since generally risk of ownership does not pass to the customer until the project is completed?
Well, that's a great question. If you look at what is in the IFRS now, the percentage of completion method is not in there. But recent comments by the IASB have stated that it does not mean a complete abolishment of the percentage of completion method. It's one of those items that they continue to work on and continue to focus on over the upcoming months.
Okay, and you've kind of touched on this a little bit, but I'll ask the question again. Are there or will there be guidelines on revenue recognition methods under IFRS?
Another great question. I do not believe that we are going to get, or that the IASB Standards Board wants to move to a standpoint where they have detailed revenue recognition guidance. It is not going to be a rules-based system. More and more guidance is going to come out as to the type of disclosures that companies need to make in their financial statements, but this is really meant to try to establish a broad base of as possible. So if you look at the 10K statements that are prepared now, if you think there is a lot of disclosure at this point, the IASB standards encourage a lot more disclosure. They want to know about the thought process. They want to understand how you arrived at the decision, not just from a quantitative standpoint, but all the qualitative standpoint. So what I see is that financial statements and the disclosures are going to get longer.
Okay. Well, this is somewhat similar to the first question, but it has a slightly different spin to it. Does IFRS allow for percentage of completion accounting, smoothing of margin for service arrangements?
Well, what it allows for is whenever the outcome of the transaction involving the rendering of services is reliably measurable, it's probable that the economic benefits will flow to the entity, and the stage of completion can be measured reliably, and the cost for the transactions can be measured reliably, then revenue can be recognized. And that is the guidance in the in IFRS right now. And unlike IFRS, in US GAAP, there's the specific performance method, the proportional performance method, the completed performance method. Those are different methods under US GAAP, but they are not specifically called out within IFRS.
Since IFRS is principles-based and not rules-based, what have you seen for companies handling consistency of application within their company? Is it more important to have detailed accounting policies so that there is consistency within each company?
Most definitely, and that's one of the things that companies need to consider as they make the transition to IFRS, particularly those that already have international bases of operation. You are going to want to have one consistent standard set of policies and procedures that apply to the broad base of companies. And you don't necessarily want to let your international affiliates drive those responses. So now is the time, even though the SEC has not committed to a set deadline as to when they will require companies, which is disappointing to a lot of people. Everybody would like that line to be drawn in the sand. But now is the time to begin the understanding of where your company fits in the IFRS framework and how that would produce different results between your company's revenue under GAAP and under IFRS.
Now here's kind of a provocative question for you, John. With the lack of rules-based guidance, do you anticipate more or less accounting scandals due to the subjective nature of IFRS?
Well, I can tell you the desire was, because of the increased disclosure that will be necessary under IFRS, that it will hopefully, there will be less accounting scandals. But I think it's one of those things where time will actually tell if that is necessarily the case. It is the desire that there will be less and less due to that disclosure, because companies are going to have to say why they did things in a certain way. And hopefully that is the case, but it seems that things go in cycles a lot in the financial reporting framework. So we shall see.
Can you provide direction where people can get a copy of the AICPA conference, the IASB six-step process?
The six-step certainly. If you go on the AICPA's website, there is it's an article called Countdown to Convergence, and it's about tracking the overhaul of US GAAP to IFRS over the next 15 months. You can also go to Grant Thornton's IFRS Resource Center, and we have frequent updates of all the happenings of the IASB and FASB joint projects, as well as the IASB boards, and continuing to try to keep the information flowing out there as to the changes that are being considered.
Since there's no concept of VSOE in IFRS, how do you prevent revenue and gross margin inflation in technical companies around software revenue recognition?
Well, that is really the job that is going to be left up to management as part of their disclosures in the financial statements, and then the auditors to actually get behind the numbers and do a lot more digging from a financial statement perspective. Now, admittedly, under IFRS, there may be one-time pickups of income and expense because you're changing from one methodology of accounting to another. And that's why it's so important that companies do an assessment of where their accounting policies stand in relation to how those items would be considered under IFRS, and then flow that through to understanding how their accounting systems reflect the substance of those transactions, and understand the changes that will be necessary from a information technology or process standpoint to understand what additional pieces of information they might need to gather to make the appropriate disclosures.
We've got a couple questions in this area, John, so maybe there's a couple follow-up questions along the same theme here. Under IFRS, you state that disclosure and statements will increase. Can you clarify what you mean by statements?
Sure thing. I believe the footnotes to the financial statements will actually increase in length, in complexity. There will be a lot more detail under revenue recognition, just as I had laid out in terms of some things that are being considered as to what needs to be disclosed. The nature of contracts, the principal judgments used in accounting for those contracts with customers. It's not going to be as easy to say, we followed the guidance under SOP 81-1, or we followed the codification topic blank. There's going to be a lot more plain English written documentation of the thought process that management used to account for items. So I believe there's going to be that increased disclosure, and usually when you have that increased disclosure, it usually manifests itself in discussing about those items in other areas of the MD&A, of a filing with the Securities and Exchange Commission, and it'll probably make your presentations with investors and the like more lengthy, as you are also educating on them on why you're making those decisions that you're making.
And how will IASB ensure that the disclosures are adequate to guard against fraud?
Well, I think it's a general progression over time, and I think we need to see the changes that are going to come from the IASB over time. I don't necessarily think that they believe that it's their job to mitigate the risk of fraud. I think that they believe that through the enhanced disclosures that will be required of companies, that there will be less opportunity to manipulate the books from a standpoint of your information is going to be out there as to why you made decisions and how you made them, and your auditors are going to sign off on that, so there'll be less a chance to get around rules versus a broad-based principle standpoint.
And we've got, I'll try and combine these two because they're both related to the residual method. It's how does IFRS affect VSOE in the residual method? And kind of the related question is, it's my understanding the residual method is going to be abolished under the new standards. Can you go into any detail on this and how separate elements are going to be measured on a relative basis?
Well, I mean, that is correct assessment. There are no separate elements, specific guidance. There is no separate element standards within IFRS. So it's not necessarily abolished, it's just not there. And as we had referenced earlier in the presentation and the example, you really need to look at what can be sold separately and what can be stripped out, or you cannot sell it separately. So in our example, we've gone over a good with a 1-year warranty, and then a extension of that warranty to 3-year period. So you have a good piece of software such, and you provide something for 1 year. It comes with it. You never sell a separate warranty. It is all just part of the transaction. So that was recognized as one piece. But you had a 2-year warranty, extended warranty, which was additional to that other piece. And the buyer had the option whether to purchase that or not. So that was separated as a separate part and recognized over that period of time. So there is a lot more focus on the substance of transactions versus making sure that we just follow rules that are in the accounting standards. And trying to reflect the substance of those transactions is what is going to then flow through to the notes of the financial statements and other areas where management describes how it reached the conclusions it did.
And John, can you comment on the changes you would see happening with the audit process? We have a few questions in that area. How the auditor involvement may be different under IFRS, and do you see this leading to more disputes with auditors based on the judgment involved?
Well, I wish I had a crystal ball. Hopefully it will add to increased dialogue between the auditors and management, but I do believe it's going to put more onus on management to document why they are making certain decisions from an accounting perspective. And it is not going to be as easy as opening up an accounting book and saying, here's why we did this. There's going to be a lot more thought that management needs to put into why they're making certain accounting decisions, and then memorialize those decisions in some internal memorandums. So I don't think it's going to lead to an increased disputes, but I do think it's going to lead to increased efforts, particularly in the first couple of years, on both behalf of management and the auditors.
So you would see the major change then would be in the level of disclosure maybe versus the dispute around what they're doing, but are they documenting it to an acceptable level?
That is correct.
Okay, thank you. And then with the changes I'm sorry, I munged this one. How close has the IFRS evolution been to the original proposed SEC roadmap?
Great question. I don't know if you have any more on that question in terms of the SEC came out about 2 or 3 years ago with a roadmap, and This past fall, we heard from the commissioner, and I think a lot of the accounting firms were hoping to hear that there was a definitive set date as to when a transition would be made, whether it be 2015, etc. The commissioner held steadfast to the standpoint that in 2011, the commission's going to make a decision as to when the transition to IFRS will be made. However, I think some of the interesting pieces of this are, if we hold true and fast to 2015, and there might be a lot of political pressure out there to do that from the world nations and the G20 and everything like that, well, you really need to start thinking, if I find out in the fourth quarter of 2011 that my company needs to file IFRS financial statements for 2015, does that give me enough runway to make all the changes, get my internal people trained up, make changes to information technology, have discussions with management, understand how it's going to impact not only external reporting but internal reporting and compensation structures and the like. So that is why, even though there may be a looseness to the SEC's commitment to a firm date at this point, it really is important for companies to start at least understanding how this could change their financial position. If it could impact the material covenant that they have from a debt position, and having dialogue with their bankers and understand, getting them to understand why that change is and how it's really just a different change in accounting method. So maybe the covenant needs to be changed slightly. Those sorts of things. It's trying to get ahead and be proactive versus be reactive and have to fall into a trap of emergency reporting and spending a lot of extra time and analysis trying to comply with these requirements towards the end of that period.
Okay, we've got a couple clarification questions here, John, on some of the questions and your comments. First one is, on the example you gave under warranty on separate elements using a one-year warranty, if the one-year warranty was optional, would it then be considered a separate element?
Well, in the example, the one-year warranty just came with the goods or services.
Right.
If the one-year warranty was optional and required you to make an additional payment, then yes, it could be considered a separate element. But to this question, I think it's hard to fathom if somebody offers you a good or service and there's a one-year warranty and it's optional, but there's no additional money. I wouldn't think anybody would ever decline the one-year warranty. So I think there would be no way around separating that one out.
Okay, and then we have a similar warranty question, which is under IFRS, would warranty be treated as a cost item or a revenue element?
Well, I think there's an aspect to both. You have to understand, what percentage of your product is coming back and needs warranty services, but there's also an aspect of if you're getting separate monies for warranties, then it's also a revenue item. So everything has a cost and a revenue aspect to it in that regard.
Okay, and a clarification question on the residual method. The residual method is only eliminated for non-software multiple elements under 0021 and not software-related deliverables under 97.2. Is that correct?
I would have to get into some further research on that. The idea is to get away from all of the detailed prescriptive guidance that we have under US GAAP and move to this much broader base. Management makes a lot more decisions under a conceptual framework. So I'd have to get into that a little bit more to provide a detailed answer.
Okay, thank you. And then coming back on the warranty, everyone's got a number of questions around the warranty topic. How is the warranty treatment different? How do you see it differing under IFRS from what we do today? And where do you see it headed under the related to the roadmap? To IFRS's original charter.
That really is a two-parter. So, if I understand that correctly, the second part is, do we think that they're going to adhere to the roadmap, or is that more to, are they going to adhere to this thing with a broad-based principle standpoint? And I would say, I believe the IASB is going to adhere to this broad-based principles, conceptual framework, to the extent that they believe that is the correct action. And I have not seen anything coming out of the IASB or their joint products with the FASB that would lead me to believe that they're going to abandon that conceptual framework. The first part of the question was about warranty expense.
Mm-hmm. How is it different from the way it's treated today? It's very similar from a standpoint of estimating what your warranty costs are and recording those in the financial statements up front as you sell the product, because you know a certain amount is going to come back and need to be serviced and replaced. Okay, and with the changes in the financial disclosures and interpretation under IFRS, do you anticipate rework or rewriting of some of the key business statutes by states and the federal system, such as UCC, statute of frauds, et cetera?
If I could answer that question, I would be a very rich man, I think. I think that there could be impact on that, and I think we're seeing it in other areas, such as IFRS's impact on tax, on the application of differences of book tax income, and the like, or expected, I should say, differences in book tax income. So there is no end to the possible changes that could be impacted by a transition to IFRS.
Is there anything available on your website that shows more examples of the differences between IFRS and US GAAP?
Yes, there is. If you go to grantthornton.com, IFRS, there is a guide of, it's approximately, 153 pages, which gives a detailed comparison of IFRS to US GAAP in a table format. And it's very readable. It gives you references to both US GAAP and IFRS. And that is, you can download that. Anybody can download that at their convenience.
And we have another follow-up question for you, John, on your warranty example.
Yep.
In the example with the product and the 1-year attached warranty, would the product and warranty be recognized over the warranty period?
I'm not sure I understand the question. Would the revenue be recognized over that one year period?
I believe, I'm trying to think back now to the original start of it, but I believe the example had the product being recognized initially, and then the revenue. I think the question here is if the warranty is attached or embedded, does the product have to be recognized over the same period, spread over the same period, or can that be taken all at once up front?
The product in the initial 1-year period can be recognized based on the fair value of the product and the standard warranty up front, as long as you need to make a provision for the estimated cost of providing the standard warranty service. So that can be recognized whenever you sell it.
Okay. Do you have a recommendation, or could you make a recommendation on a company's financial statements filed under IFRS that you think would be representative of what's going to be required for U.S. companies?
You know, I can't personally make a recommendation. I think it's all based in the facts and circumstances of each individual company. So I think it would be that would be too. It might provide people false guidance if I did that. Mm-hmm. What I would recommend is that companies look at their largest, most comparable organizations that in their peer group who they think they're most similar to, and go out and look at their financial statements and see if they're following IFRS or not. There are a few companies filing IFRS, but there have not been a lot. It has not been a rush to early adoption of IFRS. And that's because there's a lot of effort in this transition, a lot of re-education of internal people, external people, and the like. So I really can't provide one simple guide for people to go to.
Okay, well, we're running up against the clock here now, John. I really appreciate that. We had an extended Q&A session here, which I think was hopefully very beneficial for people. And thank you for spending the time on that. I'd like to thank our audience for their participation and for all of the questions. Hopefully that made this session more informative for you today. Sorry, I didn't push the slide for you next. On your screen now, you'll see the survey information. You should see a pop-up, and if you fill out the survey information in the pop-up, that will give you access to the slides. If you don't see the pop-up, you'll see the URL that you can go to there listed on the screen. And I also wanted to point out that on the revenuerecognition.com website that you see referenced on the slide in front of you there is an active forum on IFRS. So if you have other questions or you'd like to post questions to your peers, that's another vehicle that you could use to gather and share information. Thank you again for attending today, and John, thank you for the informative session.